Hello, and welcome to Beyond the Deal, a podcast where we go deeper than the numbers and we talk about what leads to success in life and business. Today on the show, my guest is Sid Shamim, a man who is quite literally living out the American dream. He immigrated here from Pakistan in 2008 for grad school with the intentions of working for a tech company, but instead he started a massive real estate investment company where he currently manages about $150 million of investor capital with over $500 million of assets under management and a couple hundred employees to boot in a fully integrated operation. So I'm going to ask him how all of this happened, and you get the opportunity to hear his amazing story. So let's get right into it. Sid Shamim, welcome to the show. Happy to have you here.
Thanks, Michael. Thanks for having me.
All right. So as always, for our guests who don't know anything about you, why don't you tell us a little bit about who you are, what you do, and then we'll talk about how you got there.
Yeah, well, I'm a business owner right now, but before that, I used to work for oil and gas here in Texas. For the last 12, 13 years, I've been really focusing on commercial real estate, particularly apartment complexes, multifamily. I run the firm. My wife is involved in the capacity of investor relations and about 200 employees plus minus, depending on at what point, how big our portfolio is. About 4,300 apartment units between Texas and Arizona. We're vertically integrated, so that keeps me busy. And if I'm not doing real estate, you will find me with kids and doing family activities. I need to do this.
Awesome. So 4,300 units, vertically integrated, family operation, got your wife involved too. But let's take it back to the beginning first. So you used to work in oil and gas, but before that, you actually immigrated to America from Pakistan. So can you walk us through that journey of how you ended up here and how you ended up working in the oil and gas industry?
Yeah, I came in 2008 for my master's degree, 2007, 2008, and fairly quickly ran out of money because the international fee is pretty high. So I found a research assistant's job at the university. 2 years fast forward, all I wanted to do is work for a tech firm. I wanted to work for Microsoft, and that was back in 2010 when the market was not, there was very less job, and I did receive an offer from them, but they were not filing for green card at the moment, and that was my reason to stay back with my oil and gas job. So we stayed with oil and gas for a long time, and my master's took me, like everybody else, we all go to college and try to, climb the corporate ladder. And as in 2014 and 13 time, oil was up and then before it was down. And I could see writing on the wall that this corporate is not for me. So I was buying and selling and holding a lot of rental houses. At one point, I had over 31 houses, and then I sold it all. I got into multifamily, investing into multifamily. So I just got into the right time. Bought a bunch of properties back in 2000, invest in a bunch of properties back in 12, 13, 14 time. And before COVID, had a substantial real estate portfolio. I wasn't planning on leaving my W-2, my oil and gas fancy job, but just so happened that when I had my first apartment complex, 140 units, I found my third-party management company not performing and doing all kinds of crazy stuff. So I literally quit my job, get back to start managing apartments. In these last 11 years, 12 years just passed by super fast.
Okay. So lots of questions here. So first of all, what were you doing in the oil and gas industry? And this is a second part to the question. I know that oil and gas syndications are very common in our industry. There's a lot of people raising capital to get into that. Yeah. How come you didn't go down that route with your background?
Yeah, good question. I think I asked myself as well. Short answer to your second question is self-limiting beliefs. I just didn't know. I just couldn't believe that I would have enough money to be a partner in a land where it's exploring and producing oil from. Never thought like that. And imagine being in an oil and gas, not knowing that there's a whole ownership aspect to it. It just tells you how limited we are when you're in your W-2. Nothing wrong with that. It's just your focus is entirely different. You're trying to learn new things, please your bosses, be a good employee, which is absolutely awesome, is absolutely great. And then all of your time is trying to climb the corporate ladder. What I was doing with the oil and gas, I was basically, so by trade, my background is computer science, but I was doing a lot of mechanical/automation work. So back in the days when AI was brand new, involved in a project that implements AI to drill for subsea and offshore projects. So very technical work that I was involved in. Multifamily was not on my radar, except I was just trying to invest. And then I got married, and then obviously my wife had a physician, so we had a bigger issue of how do we invest better, and that's where it's all started.
And so leaving the oil and gas job, was really a function of necessity, right? Because you had to become a property manager. Now, before we get into that, which is, I'm really, really curious about this whole process, you said you owned a lot of single family.
Yeah.
So when did you first decide to start becoming a real estate investor, and how did your eyes ultimately get opened to multifamily?
Yeah, I actually got engaged with a local group here in town, and single family was just simpler to understand, right? I mean, as a newbie, you can easily understand that you can buy this house and you can rent it. I mean, pretty straightforward. I got tired after certain houses, and what happens is your ability to take a bank loan after a certain number of houses get severely hampered, and that was one of the restrictions I was facing as I was growing more and more in single family houses. However, I was also, because of this network that I was in, I was also investing passively with other people, but hoping not to get in. And I never had an intention to buy a big apartment complex on my own. By the time I got into 15 to 20 houses, I realized this is just way too much management. And I wish it could be in just one place and I could hire a manager, which is much easier in multifamily or not in being single family house.
Absolutely. I mean, I've been through this journey myself, and I often preach about the economies of scale of multifamily. You got one property, you got 100 toilets. They're all the same kind of toilets, all the same kind of floor. It's all the same paint coats, right? And you got one handyman who's on site all day instead of having him drive around all over town. So, I mean, you're preaching to the choir here about, the most logical step into graduating into commercial real estate and multifamily from single family. And I believe it's 10 houses that before the bank starts, forcing you to
Yeah,
get
I
really
think back
creative.
in when I was doing it, it was they start pushing back after 5.
After
So
5.
they changed a lot of terms. They don't consider it as a residential loan or an industrial loan. They actually consider it as a commercial loan. So they changed quite a few things after 5. I don't know what's happening now. I'm talking about 2011, 2012 time. So you could have been drastically
Yeah.
changed.
And so you went through the journey that a lot of people go through, which is they find out about real estate syndication as an LP first
Yeah.
and gradually kind of become GPs after being an LP a few times. And that's actually exactly what happened to my business partner as
Yeah.
well. So why did you take the leap? Why did you switch? When did you become a GP?
Yeah. So, like I was saying, I was investing passively, and it just so happened that I was just, throughout this oil and gas journey, the oil market was just keep fluctuating. If anyone remember between what happened between 2008 all the way to 2016, the oil pricing goes up and down, and that directly impacts oil and gas companies to keep employees or forgo employees. Right? So I was just very, very cognitive of that, and was always scared if what happens when job goes away. And I was just keep bending that, the investing. Long story short, apartment complex. The moment that I realized that, I was talking to one of my mentor, and it just clicked me that it's just not any different than what I was already doing with single family. In fact, it was much easier when I realized that the tax benefits I'm going to get, which was the one biggest thing that was like, okay, cool, this is what I want to do. That's why I want to do it. So in short, it was a tax benefit that was coming along with it, and lesser management for sure.
Right. And so for our listeners who aren't aware, for those of them who haven't yet invested in a multifamily syndication, can you explain how the cost segregation study works and the tax benefits that could be available to them and how significant it really can be?
Yeah, look, I mean, I hope this doesn't go to IRS, but in the last 10 plus years, we have not paid any taxes. Our effective tax rate is 22%, 0.02. In that, in short, it all depends on your personal situation. So obviously, don't take it as another CPA, so it's not a CPA. But when you buy a commercial real estate project, with time, that project or that real estate or piece of real estate depreciates, which you can do a depreciation study that brings you the most depreciation up front. In your depreciation schedule, inverts into descending order. So you get the biggest depreciation early on, and then later in the years you take less. If you have an active income, that depreciation can impact your active real estate income, right, which is what we qualify as. So again, you have to qualify as a rep status. There are other ways that you can handle that. But I've seen people who been into real estate they have been in real estate for 20 plus years and still deferring their using strategies to pay these amount of tax.
Absolutely. And so rep status being real estate professional status. And so that means that if you are just a regular LP with a W-2 job, you're not going to be able to offset your ordinary income by doing a cost segregation study. But there are tons of different ways that you can get creative with getting the real estate professional status. I know a lot of people say that they get an Airbnb and have their wife manage it,
Yeah.
and there you go.
Yep. Yep.
There's a
There's a lot
couple
of other
there.
ways. I'll just add one other thing for your listeners. This not only that you can get the help service through being an active owner and commission lister or any kind of realtor. You can even have there are more than I think 5 or 6 categories that you can qualify for. Obviously, realtor is one of them. If you're a realtor or full-time realtor, and if you're a full-time roofer, if you're running a roofing company, you can also qualify for service. Something that we found out about 2 years ago. So the key here is, or the takeaway with this question is explore, right? Don't be in silo. Listen to experts or even podcasts like this. And there are so many ways that Iris allows you to be a part of their offering as a tech school. It's a matter of finding it out.
Hey, really quick, I hope you're enjoying this episode. I just wanted to stop for a second and thank our sponsor, which is me. Nimble Capital Group is my boutique investment firm, where we help passive investors access deals built for cash flow, equity growth, and powerful tax benefits. And if you think you've ever wanted to learn how to raise capital and become a GP yourself, I coach a select group of students each month, most of whom will raise over $500,000 within their first 60 days. So check the show notes in the description below to book a call. I'll see you there. All right. So I want to go back to that moment when you realized I'm going to have to become a property manager. What was that like? What was your mindset at the time? Did you own a bunch of properties and it made economic sense? Did you just own the one? Walk us through becoming vertically integrated.
Yeah, I think I only had one property. I didn't know much. I had some friends and some mentors, and the unanimous feedback from all of them is to go manage yourself. A lot of times people give you advices, based on the given information. If somebody asked me today, hey, self-management is better, I would have definitely say yes. But at that time, it may not be the best approach for me because I was already working in W2. But the situation at that time was pretty tough in a way that I found my third-party banking company not only not performing what they're supposed to, but also doing financial misappropriation. And that ended up for me to take immediate action. Basically, I went to my boss and asked him for a 1-year sabbatical. He approved it, and then he said that year passed pretty quick. I went back to the property. It's a pretty old 1965, Hispanic demographic property where I was the only person who was not speaking Spanish. Google Translate helped me quite a bit. I left my high-rise, fancy oil and gas office to a C-class property office. I was quite a bit of a shocker. But I had to do what I had to do. I had to go back and take the control of the business. It was not only my investment, it was my friends' investors, investment, and other, the investors' money, right, on the line. It turned out fine. I mean, it was 140 units, and I pretty much threw myself into the learning mode. I knew quite a bit from, just by dealing with this third-party management company. I was just trying to audit them all the time, and that gave you quite a bit of confidence in terms of how the financials should look. Today I'm different. I can look at a financial and I can tell if somebody's stealing paint in the property or not.
Wow.
Why this item is high or what this item is low. So that was quite a learning. I think I'm glad that I did that. It was painful. It was scary. First 6 months were every day was new decisions to make. Made a lot of mistakes but in the end it was, it turned out really good.
Do you speak Spanish now? Did you learn in those 6 months?
Well, but I can understand quite a bit. Speaking is still.
All right. So you went from 140 unit property where you're actually on site managing it. And let's fast forward to today for our audience who isn't aware, you transacted on over $600 million worth of real estate and you've raised $150 million of investor fund. That last bit is the part that is particularly interesting to me, being that my world is capital raising. So can you talk to us about, I know you said 4 of your investors were your very close friends, but can you talk to us about how you got into the world of capital raising and what sort of things you were doing to find your investors? How many investors do you have now?
Yeah, good question. So, back in 2012 and 13, I mean, very, very, very few gurus are out there. The world of syndication was brand new, right? Obama's law came out, were very fresh. And we didn't even know about, syndication papers and what is a PPM and things of that nature. It all came into action after 2015 and onwards. In fact, back in those days, if you're not raising more than $1 million, you don't need a PPM. Those were the days. So, it was a pretty classical way of friends and family, people that I start contacting people that I know from my college, people that I had a good GPA in my college, so a lot of people were coming to me for homeworks, help, and all that. So I started reaching out to them, and they kind of knew me in a good light as a good student. Obviously, didn't know me as a businessman, but going through my phone, going through references and talking to the brokers and saying, hey, if you know anybody. So really word of mouth. Didn't have any website, didn't have any podcast. This is probably I don't know too many podcasts. This is probably my 10th or 11th in the whole career. And I've seen people doing 10 podcasts in 1 month. So I'm pretty behind on that for sure.
But welcome to the circuit.
So, yes, that's kind of goes to Brian. He's pushing me for that. So that's really how I raised capital. I put a lot of money of my own. That was a help because I was selling some of my single-family houses. So that was surely a help. My first deal was like $500,000 myself. It was, nerve-wracking. That was one of the other stronger reason for me to quit W2 and start setting into being a property manager. And that kind of helped. Yeah, that kind of helped, people look, hey, yeah, I'm going to invest with you $500K because you're in for like 480 or something like that. So that really helped in terms of, we still have, anytime when we buy anything, we still are the biggest investor in our deals. There's just, in this 99% of the time is what we do. Our philosophy is, inch wide might be, and knowing all about this one asset class that we know for sure. You tell me this asset class anywhere in Texas and just tell me the number of units. I don't know underwriting. We have seen so much that this spreadsheet underwriting is for analysts, just not for business owners.
Amazing. All right. So how are you managing today? I know in the beginning, you mentioned you have a couple hundred employees, depending on your unit count, right? So I assume that extends all the way to maintenance staff and property managers and everything like that. But tell us about this empire that you've built.
Not an empire for sure. I think it just grew organically in the last 12 years. So we've about, 11 core employees, which includes our asset manager, or CFO, or investigation, or HR person, or recruiting person, or accountants, or supervisors, or auditor. Those are the key players. After a lot of buying and learning, we all say it's all about who you have in your team. But it's very, very, it's easier said than done. And I get to learn that with first-hand trial and error, doing mistakes. And so my first 2 or 3 deals, I was just managing myself. Grew to a point of 5 deals, and I realized I can hire a supervisor. That took me 4 supervisors to realize what is a good supervisor looks like. So far, I think I was just going through our interviews history. We done over 600 interviews to keep 200 people. So we went through this whole process, which reminds me over and over again that there's no shortcut to do anything, right? Even if you fail in something, you can't just take a shortcut, right? So that was a brute force approach in terms of building team. Today, we've got these team members that I believe are benefits to things that we offer to employees, or I don't think anybody in our tier or our competitors are doing it. For example, after 10 years of service, we offer employees to pay down their down payment for the house if they're buying a house, even if it's a house for themselves or buying as investor property. But that's, that person to stick with us for 10 years speaks volume, right? And then similarly, we have different tier of bonuses, and the way we have structured it, we have double down bonus structure, where you as an employee achieve your bonus, we will double it, in a good portion of it will be paid next year. So you're incentivized to stay longer, perform better. And those are all of the things that I came up with my team, but that's after deep thought in making sure our slogan in our company is it's all about people. And how do we really define that? What does it mean? I can come to I can celebrate your birthday, write a small birthday card. It's probably going to cost me $50. But to truly add value in your growth financially, mentally, and professionally, it requires not only expense, but deeper thought.
That's amazing. So what I'm hearing is that you're attributing a lot of your current success to the way that you have chosen to treat your employees and the people and the team that you've built, and the way that they continue to build you and reward you.
And I want to clarify that. I mean, it's not easy for our employees as well. Like, we have high expectations, and a lot of people don't stick around too long. Our accountability structure enforce not only for our employees to be accountable, for me to be accountable as well. And one of our core values is that if I'm not taking care of employees, sure enough, then I'm going to take care of my business.
Understood. You've been doing this a long time, more than 10 years now, since before the word syndication was even mentioned. This is kind of a 2-part question. First question is, what is the worst part of the cycle? What is the worst part that you've gone through? Tell us about a deal that maybe went sideways or a timing issue.
Yeah.
And part 2 is, where do you think we are now, and what do we have to look forward to?
Well, I guess I don't want to say good news, but I think we don't have any deal that is in foreclosure of any kind as of today. We do have a couple of deals that we paid too much And what I've seen us doing differently than our competition is a competition, they don't really, running multifamily, that kind of business, you have to have a strong liquidity backing you so that you can fund those deals. And I'm sure you've seen those examples as well. Not every deal will perform like a shining star, right? There'll be some slam dunks and there'll be some, failures. So some of the deals that there are two deals in particular that we've been injecting money to make sure we get out of this floating rate debt, to make sure we go back to the safe harbor. And a lot of it is also how the market has changed in that submarket. What we have seen, unfortunately, not everybody is keeping up with it or cannot keep up with it. I mean, nothing, I can't blame them, but just that's how it is right now. So I guess knowing, even though we know our operations, that our operations are our strengths, obviously we are not, we want to say we are perfect, but there's always new things that we've been learning. The things that we do in terms of finding federal grants to change HVACs on the property, or to change all the HVACs on the property, or change the toilets on the property. Those are things that we learn to do it, that we believe our competition is learning to us.
No, they're not, because I haven't heard of that, and I'm in this industry, and now I'm curious. So you're finding federal grants to get HVACs changed?
Yes, it's one of our secret sauce. One of our secret sauce to save cost.
That's amazing. But yeah, going back to the question, I can guarantee you that, myself included, probably you included, anybody who's listening who bought a deal in the first 6 months of 2022, you probably overpaid for it. And if you had a floating rate debt, you're probably feeling the hurt right now, right?
I want to add here one thing. So we didn't buy anything in 2022. We actually got last contract that we got into was 2021. And unfortunately, one of our deals was dragged into 2022 because of several complications. But we knew that the writing was on the wall, interest rates are climbing up pretty fast. 2021, true last purchase. And then we paused for some time. And then last two deals that we did was last year. And those are pre-foreclosure deals. So now we're focusing only and solely on distressed assets, which is one of the questions that you asked. I think I missed that. Where do I see this going? I strongly believe that this market is cyclical, right? It's cyclical in nature, that anytime when there's a time to buy, time to sell, right? This is not time to sell. It's time to buy. I guess everybody agrees to it. Do I think it will go back to those crazy times of 2018, 2019, even 2020? I don't think it will go that far into the rate compression, but who knows? People have to live somewhere. Apartment complexes are one of the strongest asset class if you buy it right, manage it right. Long story short, I think this market, we've been talking about it quite a bit. This market is the market to buy, is the look for, don't get fooled for, high cap rate. Oh my God, this is such a nice location. The more we have done so far, these deals, the more I learned that it's the two things that's super important, obviously the location, but the price per pound that you're going in is extremely important, right? I've seen at least two sponsors in particular, they time the market so well that even if your operations are not up to mark, because you're timing it so.
Yeah, absolutely. I mean, so that kind of was really the whole point of my initial question, is you having lived through 10 to 15 years of this at this point. How much, I remember in the beginning in 2020, people were buying deals that they planned to hold for 5 years on a 2x equity multiple, and then they would flip it in 18 months, right? Get that return. So how much of success in this industry is truly timing the market versus being a really exceptional operator? Obviously, I know there's nuance here, but what is your opinion on this?
The reality is there's always new capital. I call it dumb capital, comes in the good times, right? And how do I put it? I think the timing is, to me, is at least 70% of the thing. However, timing cannot be everything, because you can have those times of 2008 and onwards, 2017 and to 2020, those 3-4 years were just crazy, right? You can literally have a non-performing deal and you can still sell it for performer. Right. Our mentality is a bit different. The way I look at it is, yes, I can time it, but what if I want to keep this property, can I cash flow it? Right. Can I truly generate a free cash flow out of this asset? And that has been always our philosophy, because when I was buying single family houses, I wanted, if a house is not producing me $1,200 a month, $1,300 a month, back in days, $1,500 a month, I wouldn't buy it. So that mentality continued, right? And we lost a lot of deals because of that. I cannot even tell you how many times we went to a seller's interview and best and final, and we were always the second or the third bidder, because we were looking for the cash flow, not the IR. Nothing wrong with that. I think there's a business model to time it, which I know a lot of people do it. Our model is somewhat hybrid. We want to keep properties and we can cash flow it. And the time is right, we'll settle for sure. But we're not buying it just to flip. Nothing wrong with it. I'm just saying that's not what we've done so far.
Yeah, and I couldn't agree more. And I know that there are operators who bought in 2020, 2021 who just absolutely looked like geniuses, and then interest rates and they're in trouble now. And conversely, there are excellent operators who have bought in the last couple of years and they're struggling because of just where we are in the market. You know, cap rates and interest rates, it's pretty interesting time in the market cycle.
Just not that the overall expense to run the property gone up. Insurances have gone up. They're coming down again, but the material cost in just the payroll, I mean, we used to pay to our manager is what we pay to a porter, right, in the last 4 or 5 years. So our payroll costs have gone up. And this is nitty-gritty that I try to promote all of our operators or syndicators to get into it. Right? Because if you don't know the nitty-gritty of the operations, it will always be an exposure for you. Right? And that can bite back pretty hard.
All right. So we are coming up on time here, but I do have one thing that I always ask my guests, and I'd love to hear about it from you. So you are the CEO, owner, founder of a massive company. You manage a ton of investors' capital, including your own capital, which is on the line all the time. And you're basically responsible for the lives of 400 plus people. How do you manage the stress? What are you doing in your daily life to make sure that the weight of that isn't, relevant to you?
Yeah. I'll answer it indirectly and then I'll answer it directly. I think and I'm thinking out loud here. I mean, the philosophy that keep us going is, you got to think big. Your smaller problems will always bother you the same way you bring a problem with. If you're zoning into something that is smaller, think of it how you can find a solution in a much bigger way that your small problems becomes negligible. For example, if I have a problem with a manager or somebody's not working out or, one deal is not performing well, I need to perform or even acquire 5-10 better deals to make sure that the other deal is not, going south. And I personally have a capacity to fund it back. That's one way, kind of indirectly. The way to manage stress is if there's a problem, there's a solution. So what's the problem? Right. If there's a problem, there's no solution. What's the problem? Right. Nothing you can do that can change. All you can do is stay. The big thing is, it's not about motivation. It's about discipline, right? I mean, I can motivate my employees 1 day, 1 year, 1 month. But if somebody's not disciplined, I cannot help.
Okay. So that's a real, knowledge bomb that you just dropped on us at the end. I love that. Sid, thank you so much for being on Beyond the Deal. I really enjoyed this conversation. Can you tell our guests if they're interested in learning more about you and investing with you, where can they get a hold of you? Yeah,
I think so. Our website, headwayinvestment.com, and our email, headwayinvestments.com. The investors at Headway Capital here. So, you guys can reach us. There's a phone number. I don't remember to give it. Brian remembers that phone number, but I can text you later on if you want to add that into the comments. But I think the best way to get to us is headwayinvestments.com is our website.
Okay. Thank you so much for being here. That's a wrap for today's episode of Beyond the Deal. I hope you got some valuable insights that you can apply to your own investing journey. Now, if you've enjoyed this conversation, do me a favor, hit that follow button, leave a review, and share this episode with somebody who you think could benefit from it. It really helps the show grow and bring on even more incredible guests. If you want to go deeper, make sure to follow me on your socials. You can find the links in the show notes in the description below. Thanks for tuning in, and I'll catch you next time. Until then, keep going beyond the deal.